Hey Lux Invest fam, welcome to a brand new series that's going to shift your money game forever. 5 money rules that will change your life and create financial freedom. If you're tired of feeling broke at the end of the month, watching your paycheck vanish, or wondering how some people build real wealth while you're just surviving, this is for you. In 2026, with interest rates easing a bit, AI tools making saving automatic, tax rules shifting under recent changes like OBBBA, and modest inflation around 2.4%. These 5 simple proven rules, updated for today's world, are the exact playbook top earners and financially free people follow. They're not complicated, they're powerful because they force discipline and compound over time. I'm breaking this into parts so you can watch one rule at a time, apply it immediately, and build momentum. Today is part 1, the intro and rule number 1, the foundation. Everything else stands on. Stick around because if you ignore this one, the other rules won't stick, and you'll stay stuck. Let's jump in. Rule number 1, live below your means. No exceptions. This sounds basic, but it's the number 1 reason most people never reach financial freedom. In 2026, lifestyle creep is everywhere. Social media shows new gadgets, vacations, upgraded cars, and it's easy to think I deserve this when you get a raise or side hustle money comes in, but living below your means your expenses are always less than your income, creating a gap that becomes your wealth building fuel. Here's why this rule changes everything. That gap, your savings rate, is the real key to independence. If you earn $5,000 a month but spend $4,800, you're left with $200, barely enough for emergencies. But if you live on $3,500, that $1,500 gap can go to debt payoff, emergency funds, or investments. Over time, it snowballs. People who hit financial freedom often save 20–50% of their income, not by being miserable, but by being intentional. How to make it real in 2026. Start with a simple audit. Pull your last 3 months' bank statements and categorize everything. Use the 50–30–20 rule as a starting point. 50% on needs, 30% on wants, 20% on savings, debt, investments. But tweak it. Many crush it by aiming for 60–20–20 or better. Cut the big leaks first. Subscriptions, eating out, impulse Amazon buys. Redirect that money automatically. Set up transfers the day you get paid so you pay yourself first before bills hit. Pro tip for this year. With rates dropping slightly, refinance high-interest debt if possible, but don't use the savings to upgrade your lifestyle. Bank it. Use AI budgeting apps like Rocket Money or Monarch to flag overspending in real time and suggest cuts. Track your freedom number. How much monthly passive income you'd need to cover expenses. This rule isn't about deprivation. It's about freedom. When you live below your means, you buy options. Time off work, travel without stress, helping family, or retiring early. Ignore it, and no matter how much you earn, you'll stay trapped in the rat race. Master it, and rule number 2 is waiting. Welcome back to Lux Invest fam, part 2 of 5 money rules that will change your life and create financial freedom. If you caught part 1, you already know rule number 1. Live below your means and protect that gap between what you earn and what you spend. That's the foundation. No gap, no freedom. Now we build on it with rule number 2, the one that turns your gap into real wealth without relying on willpower every month. Pay yourself first and automate everything. This rule is simple but powerful. When money hits your account, the first thing it does is go to you. Not bills, not lifestyle, not debt beyond minimums. It means treating savings and investments like a non-negotiable bill. In 2026, with AI making automation stupid easy and rates still decent on high-yield savings, this rule is easier than ever to execute and harder to ignore if you want freedom. Why it changes lives. Most people pay everyone else first, landlord, utilities, Netflix, takeout, then hope there's something left for savings. There rarely is. Paying yourself first flips the script. You force wealth building to happen automatically. That $200–500 or more you transfer right away compounds over years into serious money. It's the difference between maybe someday and I'm on track for early retirement or quitting a bad job. How to do it right in 2026. Step 1. Decide your percentage. Aim for at least 10–20% of gross income to savings investments, more if you're aggressive. If you're starting small, even 5% beats 0. Step 2. Automate on payday. Set up direct deposit splits or recurring transfers the day income lands. 10% to high-yield savings. Ally, Capital One, or SoFi still offering solid rates. 10% to retirement. 401k match first, then the rest to checking for bills. Tools like Rocket Money or Monarch AI can scan and suggest optimal auto moves based on your patterns. Pro moves this year. Max any employer 401k match, it's literally free cash. If rates dip more, lock in high yield now for emergency funds, 3 to 6 months of expenses. Use AI features in apps like Clio or Acorns to round up purchases and auto-invest spare change, tiny habits that add up fast. For taxes, automate extra withholding or contributions to Roth IRA to leverage any OBBBA perks. Common trap to avoid: don't automate so much you bounce checks. Start conservative, then ramp up as you adjust. Track the first few months. Watch your net worth tick up even when life feels normal. That's the magic. Wealth builds in the background while you live. Rule number 2 isn't sexy, but it's the engine. Combine it with living below your means from part 1, and you're unstoppable. Apply this today. Log into your bank, set one auto transfer to savings or investments, even $50 per paycheck. Feel the shift. Like the video, subscribe for part 3, and comment. Did you automate something today? What's your percentage goal? Let's see those commitments. Rule number 3, crush high interest debt first, ruthlessly and strategically. Debt isn't evil if it's smart, like a low-rate mortgage for a home that appreciates, but high-interest consumer debt is a wealth killer. In 2026, even as overall rates ease, credit cards and some loans stay sky-high. Interest compounds against you. It turns $5,000 owed into $10,000 or more over time if you only pay minimums. Rule number 3 says attack it aggressively, so more of your money gap goes to building freedom, not paying banks. Every dollar you pay toward high-interest debt is like earning a guaranteed return equal to that interest rate. Paying off 22% APR debt is better than most investments. Once it's gone, your monthly cash flow explodes. An extra $300 to $500 freed up for investing or emergencies. People who follow this hit financial independence faster. Two proven methods for 2026. Pick what motivates you, the debt snowball or the debt avalanche. Debt snowball. List debts smallest to largest, pay minimums on all, throw every extra dollar at the smallest one, win quick. Psychological momentum keeps you going. Celebrate those early zeros. Debt avalanche. List by highest interest rate first. Attack that one hardest. Saves the most money long term. Great if numbers fire you up. It's about efficiency and saving every cent of interest. Hybrid tip: use snowball for motivation, avalanche for math. Refinance where possible as rates dip. Use AI apps like Rocket Money or Undebt.it to track, predict payoff dates, and suggest strategies. Action steps right now. List all debts. Calculate your extra monthly payment. Pick your method and automate. Trap to dodge: don't pause debt payoff for fun spending. Lifestyle creep kills progress. Stay focused. Rule number 3 clears the path. Debt-free cash flow is rocket fuel. Make your list today. Like, subscribe for rule number 4, and comment your debt target. See you in the next one. Rule number 4, invest consistently, no matter the market noise, and let time and compounding build your wealth. Consistency beats timing every single time. The market goes up and down, but historically, investing regularly in broad, low-cost index funds or ETFs wins long-term. Compound interest is the 8th wonder. Your money earns money on itself, snowballing exponentially. Start early, add regularly, stay invested. That's the formula for financial freedom. Why this rule is life-changing. Once debt is gone and savings are automated, your gap can go to investments that grow without you working harder. A $300 a month investment at 7 to 8% average return, S&P 500 historical, could hit $500K plus in 30 years. In 2026, with rates easing, mortgages forecasted around 5.75 to 6.3% by year-end, refinancing frees cash. And AI robo-advisors make starting simple. No need for stock-picking expertise. How to apply it right now. Step 1. After debt minimums and emergency fund of 3 to 6 months in high-yield savings, direct your automated gap to investments. Step 2. Choose simple vehicles. Start by maximizing your 401k match first. That is literally free money. Then look into a Roth IRA or traditional IRA. The limits are solid in 2026. Use robo-advisors like Betterment or Wealthfront. AI builds diversified portfolios, rebalances automatically, and tax loss harvest with fees at 0.25% or less. Or go DIY with Vanguard or Fidelity index funds like VTI or VOO for total stock market exposure. Pro 2026 moves. Dollar cost average. Invest fixed amounts monthly regardless of market highs or lows. This reduces timing risk. Use apps like Acorns for micro-investing roundups. If rates drop more, consider shifting some savings to bonds or balanced funds for stability. Trap to avoid. Don't chase hot stocks, crypto hype, or get rich quick. Most people lose. Stick to boring, consistent investing. Don't pull out during dips. Time in the market beats timing the market every single time. Rule number 4 makes your money work for you 24/7. Combined with the first 3 rules, you're building a machine that creates freedom. Apply today. Open or check your retirement account. Set or increase one auto investment, even $50 a month. Watch it grow. If Part 4 inspired you, like the video and subscribe for Part 5, the final rule: protect your wealth and build legacy. Comment below. What's your go-to investment vehicle in 2026? Robo-advisor, index funds, or 401k? Share your starting amount goal. Hit the bell. Your wealth is compounding. Rule number 5. Protect your wealth aggressively and plan for legacy, because building is hard, losing it is easy. Life happens. Job loss, medical emergencies, lawsuits, identity theft, death. Without protection, one event can erase years of discipline. In 2026, with fraud rising, AI deepfakes phishing smarter, insurance premiums climbing modestly, and digital tools making planning simple, this rule is non-negotiable for true freedom. Why it changes everything. Financial independence isn't just enough money, it's enough money that stays safe. A solid emergency fund covers 3 to 6 months or more if self-employed in high-yield savings. So you never touch investments during tough times. Insurance, health, disability, life, umbrella liability shields against catastrophes. Basic estate planning, will beneficiaries, digital asset access, ensures your wealth goes where you want, not to courts or taxes. Legacy means teaching kids money rules or leaving something meaningful. How to lock it in during 2026. Emergency fund first, keep it liquid, high yield. And separate from checking. Build to 6 months if volatile job market. Insurance audit, review health disability, employer or marketplace. Add term life if dependents, cheap in your 20s, 40s. Consider umbrella policy, 1M plus coverage, low cost. Shop annually. Rates shift. Fraud protection. Enable AI alerts in banks, apps. Use password managers. Freeze credit with Equifax, TransUnion, Experian. Turn on 2FA everywhere. Estate basics. Write a simple will. Name beneficiaries on all accounts. List digital logins for family. Update after big life events. Pro moves this year. Use AI tools like Credit Karma or bank apps for fraud monitoring. If rates ease further, keep emergency fund in top yield accounts. Teach one money rule to family kids. Legacy starts with knowledge. Trap to avoid. Don't skimp on protection thinking it won't happen to me. One accident or hack can reset you to zero. Don't overinsure. Balance cost versus risk. Rule number 5 is the vault. Build wealth with the first 4, protect it with this one. Together, these 5 rules aren't theory. They're a proven path to financial independence and peace. Full series recap action. Review your gap. Rule 1. Check automations. Rule 2. Track debt payoff. Rule 3. Confirm investments. Rule 4. And strengthen protection. Rule 5. Revisit monthly. Small tweaks compound huge. You've got the blueprint. Now execute. If the whole series transformed your thinking, smash like on this finale. Subscribe to Lux Invest. And comment which rule is making the difference. Hit the bell. More wealth building coming. Thank you for watching the full journey. Your financial freedom is in motion. See you in the next series.